Hello students, greetings of the day. St. Joseph's College for Women Autonomous Vishakhapatnam welcomes to St. Joseph's open web-based learning platform. So e-learn for a soulful and enriching e-learning experience. Department of Commerce and Management of St. Joseph's College for Women Autonomous presents SMOOC, St. Joseph's Massive Open Online Course. I am R. Pavani, Assistant Professor, Department of Commerce and Management of St. Joseph's College for Women Autonomous Vishakhapatnam. Would like to teach you third module, Accounting Principles in Introduction of Commerce. The fourth submodule of Accounting Principles module is Accounting Conventions. The outcome of this chapter are students will be able to understand how conventions promote uniformity in accounting practices, learn the importance of the disclosure convention in ensuring users get all relevant financial information, apply the conservatism convention to recognize potential losses early and avoid overstating profits, recognize how accountants apply conventions in daily practice to deal with ambiguities and make judgments, and to build a base for understanding more formal accounting framework like IFRS or GAAP, which incorporate these conventions. The contents of this submodule are GAAP and accounting conventions. GAAP, generally accepted accounting principles, refers to a set of accounting standards and guidelines used to ensure consistency, transparency, and comparability in financial reporting. It is a technical accounting term that encompasses the conventions, rules, and procedures necessary to define accepted accounting practices at a particular time. The purpose of GAAP is to provide a framework for accounting practices to ensure that financial statements are accurate and reliable. Its primary purpose is to maintain consistency and transparency in financial reporting, making it easier for stakeholders to compare financial information across different organizations. The principles of GAAP are principle of consistency, principle of permanent method, principle of non-compensation, principle of prudence, principle of regularity, principle of sincerity, principle of good faith, principle of materiality, principle of continuity, principle of periodicity. The components of GAAP are principles, assumptions, and constraints. Principle means the core guidelines that govern the accounting practices. Assumptions means basic premises such as going concern and monetary unit assumptions. Constraints means limitations such as materiality and cost-benefit considerations. These principles are accounting concepts and conventions. You learned about accounting concepts in the previous video. Now we are going to discuss about conventions in this video. Accounting conventions are certain restrictions for the business transactions that are complicated and are unclear. Although accounting conventions are not generally or legally binding, these generally accepted principles maintain consistency in financial statements. While standardized financial reporting processes, the accounting conventions consider comparison, full disclosure of transactions, relevance, and application in financial statements. The accounting conventions are convention of consistency, convention of disclosure, convention of conservatism, convention of materiality. Now we are going to discuss in brief in the further slides. Consistency. The consistency convention requires that accounting methods, policies, and practices should be applied consistently from one accounting period to another. This principle enhances comparability and reliability in financial statements as users can rely on consistent information for analyzing the financial performance and position of the business over time. In this convention, companies should choose the most suitable accounting methods and treatments and consistently apply them in every period. Changes are permitted only when the new method is considered better and can reflect a true and fair view of the financial position of the company. The change of any method will affect on profits should be disclosed in the financial statements. According to disclosure convention, the full disclosure requires that all relevant financial information that could impact the decisions of users should be disclosed in the financial statements or accompanying notes. This principle promotes transparency and accountability by providing users with a comprehensive view of the financial position, performance, and risks of the business, thereby facilitated informed decision making. According to this convention, all material and relevant information must be disclosed in the financial statements. Financial statements should be prepared to reflect a true and fair view of the financial position and performance of the enterprise. The Conservatism Convention advises accountants to exercise caution when making estimates and judgments, preferring to recognize potential losses and liabilities as soon as they are probable, but to only recognize gains when they are realized. This principle ensures that financial statements do not overstate assets or income, promoting prudence in financial reporting. In this conservatism, profits are not anticipated, only realized profits with reasonable certainty are recognized in the profit and loss account. However, the provision is made for all known expenses and losses, whether the amount is known for certain or just an estimation. According to this convention, all the possibility of losses should be made in the business, like reserve for bad debts. The bad debts may happen or may not be happen, but the businessman have to create reserve for bad debts. But the profits which we cannot anticipate, only realized profits with reasonable certainty will recognized and can show in the profit and loss account. According to this convention, it minimizes the reported profits and the valuable assets. The materiality convention suggests that financial information should be disclosed if its omission or misstatement could influence the economic decisions of users of financial statements. This principle helps prioritize information that is significant and relevant while allowing for the exclusion of trivial details that do not impact the overall understanding of the financial statements. Materiality depends on the size and nature of the item judged in the particular circumstances. Immaterial amounts may be aggregated with the amounts of a similar nature or function and need not be presented separately. So students, now check your progress. Accounting conventions are accepted practices used to make financial statements clearer and more consistent. They are not legally binding rules, but they help standardize accounting procedures. So the activity of this submodule is take one business organization and then find out how the accounting conventions would apply to the business. Thank you, students. I hope all of you understood about the concept of accounting principles. In this, we learned introduction of accounting, accounting concepts, conventions, generally accepted accounting principles, types of accounts, rules of accounts, and accounting cycle.